Roku just reported, and it was ugly. They are down big after market. They are down 21.4%. This is our software, guys. If you're new to our channel, check out the software. It's incredible. But right now, they're down 21.3% after hours. But here's the big thing. Roku is a big holding, and I think still is a big holding of Cathie Wood at Ark Investment. She only invests in disruption. Well, disruption kind of looks like this. $454 is the high, $73 is the low, and is now barreling through that $73 level. It's now at $67 per share after hours at a one-year low. In fact, the last time they were there was COVID. That was the last time they were at $66 or $67. Actually, they're below where they were for COVID. The low of COVID was higher than it is today. Now, let's go to their actual press release to look at exactly what happened. So, total revenue grew 18%. So you sit there and hear that and go, that's incredible. But here's the problem. It went to $764 million. Analysts were expecting $806 million. That's a big miss. Okay. Now, another thing. Analysts were estimating 70 cents earnings per share. That's a profitable earnings per share. They don't even mention earnings per share here. What we have is a loss of $110 million last quarter. In the quarter, they lost $110 million. How many shares outstanding do they have? Let's go to their income statement. They have 130. They lost almost 70. They lost like 70, 75 cents a share instead of making 70 cents a share. That's a big, big miss. That's why the market's beating up Roku right now. Big earnings day. If you're new to this channel, I'm Paul. I'm a value investor. I like to look at earnings results, but I don't like to focus on them. I want to make sure the company's still making headway on my assumptions. Now, one thing I'll tell you guys, if you look at Roku, this 18% growth number is awesome. If you were able to buy Roku many years ago based on a number lower than this growth level and you're in the profit, you're still happy. It's only if you're a recent buyer that assumed everything was great and now they're down 85% that you're upset about it. Okay, that's the difference between investing and speculation. In investing, we make conservative assumptions and look to preserve our capital and make gains along the way. With speculation, you have Roku here. Look at Roku. They did $2 billion in revenue and their stock was $450. Look at this. Their price to sales ratio is 4 currently. That's after being down 85%. That means their price to sales ratio should be 24 right now based on history. This is the Cathie Woods. This is what she loved. So let's go look at our 8 pillars right now. Our 8 pillars tab will give us the 8 metrics here. So interesting things here. The 5-year PE, 770. The 5-year price to free cash flow, much lower, but still 215. Look at this. Diluting the heck out of their investors. 58% increase in the shares outstanding. Okay, now some good news. I don't follow the ROIC and the debt levels when it comes to growing companies. They're going to spend a lot of their cash flow, reinvesting back in the business. So that's going to be affecting these 2 areas. I'm not as worried about it. Yes, they had revenue growth. Yes, they had profit growth. Yes, they had free cash flow growth. But it's not enough to justify these really, really high valuations. I'm willing to bet that it'll be many, 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 many years before Roku ever hits $450 a share again. Many years. This is going to be a tough go for Roku. I like Roku. I use Roku at home. We use Roku in our investment properties in Mexico. We like Roku. But just because you like a company does not mean the stock is the right stock for you. You have to separate the company from the stock price. There are significant headwinds. They write it here in their very first statement. Significant slowdown in TV advertising spending due to the macroeconomic environment. Is that true? I don't know. It's a good thing to say because everybody's going to buy into it. But is it true? That's the question. That pressured their platform revenue growth. Duh. Consumers began to moderate discretionary spending. Now, with that said, if you watch my other videos, I talk about this supposed recession we're in. I don't know if we are or not, but consumer sentiment is at an all-time low going back to 1950. All-time low. That means people's perception of their financial health now and in the future is bad, and their discretionary spending is going to be pulled back. So maybe they are right here. That is a concern right there. And that's going to affect a lot of people and a lot of companies, right? But your job as an investor is to make conservative assumptions on a company and then use those assumptions to determine what price to pay. Luckily for you, we have our stock analyzer tool. This is what we use to determine the price to pay for a company today based on our assumptions about the future. But remember, I make very, very conservative assumptions about the future. So let's do a 10-year analysis on Roku. For the record, I don't know if Roku is going to be around in 10 years. They're either going to close up shop or be bought out by somebody. So let's take a look. I mean, I don't think they're going to be bought out because they are very reliable, but Apple TV is everywhere right now. So let's do some revenue growth numbers. In the last 5 years, I did 51.9% revenue growth per year. I'm going to go very conservative here. I'm going to go with 10, 17.5, and 25% revenue growth. Profit margin. Now, I'm probably going to do 5, 10, and 15 because they do have a healthy gross margin, I believe. Let's go back to their gross margin. Let me go back to our software here and look up our gross margin on Roku. The gross margin on Roku is 50%. So every dollar they bring in revenue adds 50 cents to the bottom line. That's how profit can be much higher. Free cash flow margin. I'm going to go 6, 12, and 18. PE. This is where everybody's going to hate me. I'm going to go 14, 17, and 20. Why so low? Guys, I get it. Roku is a fast-growing company, but you have to do the PE based on where it is going to be in the future. It's going to be hard for them. Now, final one, desired return. I want a 15% return here. I usually do 12.5% on more established businesses, but there's a lot of speculation here. There's a lot of assumptions we're making. We don't know about the future. So I'm going to hit the analyze button. They're now down 24% after hours. So they're at 64.90. I hit the analyze button. Below is going to pop up 6 numbers based on earnings and free cash flow, low, middle, and high estimates. If all are green, that does not mean you go buy the company. It means you go make sure your assumptions here are correct. If they're all red, then you can either choose to ignore. Let's say, for example, $65 we're at right now. Let's say it goes to, the assumptions are $20 a share. Don't even waste your time. Move on. So analyze, go down below. Okay. Guys, I was actually surprised by this. But look how wide-ranging these assumptions are. $20 a share, $200 to $250, and somewhere in the middle is $70 to $80 a share. So does that mean go out and buy? No. This means that if you believe these middle numbers here, and you believe they're not going to dilute the heck out of you by issuing more shares, you should do more research on it and make sure these numbers are accurate. These don't seem like unreasonable numbers, guys. They really don't. These do not seem like unreasonable numbers. The question to ask yourself is, are they likely to happen? And if that's the case, take the next steps. If you like this video, I really appreciate it. Subscribe to our channel. It'll be the best thing you do. And thank you for your time.